Our net interest margins have gone up by about 18%. If you compare Q1 2018 with Q1 2017, we've also had a strong quarter of treasury earnings, fixed income securities trading. So that's actually the main boost to the top line in Q1 18.
A good thing you mentioned treasuries. I'm sure you're aware of what's going on at the treasuries market, at the fixed income market, where we're seeing that yields now broadly lower because of what the federal government is doing, pulling back on domestic debt. Yeah. And there's been a lot of talk and conversations about how this could impact on banks' earnings, especially banks that rely heavily on that aspect of their income stream. What are your thoughts on that? How is that going to impact on your earnings?
I mean, ultimately, the job of the treasurer is to take advantage of the yield curve, right? The amount of liquidity you have makes a difference also, but as the treasury bill rates go down and affect the top line, there should be a commensurate reduction in cost of funding as well. Okay. Okay, so the trick will be how to optimize the spread and make sure that you're not losing more on the interest income side than you're spending on the interest expense side. Okay,
so in other words, bottom line, you're not concerned about this trend, even if we do see yields, although the central bank is now trying to get those yields up, to keep foreign investors in the market. So that's not a major concern for you.
The banks make money from the margin at the end of the day, right? So if the interest income is coming down, you should be looking to optimize, bring down interest expense. So that will be the trick.
Okay, so your bottom line, the profit after tax was up 17%. Yes. In your opinion, is 17%, was that a good percentage increase for your bottom line for the Q1?
I think a 17% increase in any period is decent, is robust. So, except I'm not getting your question. Yeah.
No, I know. No, yes, you did get it. 17. I'm just thinking, as in, were you expecting? Are you satisfied with the 17%?
I mean, of course, we can always do better, but we think we had a pretty strong quarter. Okay. There are quite a few metrics we're very happy about in our Q1 results. Apart from the 18% improvement in our net interest margin and the 15% improvement in on the gross revenues, we've seen our non-performing loan ratio come down.
I was just going to talk about that.
So those are sort of trends that we're quite happy about. We've seen our return on equity, our return on assets. All those metrics are up relative to last year.
Let's talk about your non-performing loan. That improved to 14.9%, but that was as at March last year, from 19.8% in January, but that was as at March last year. Any further improvement?
Yes, our ambition this year is to come down below 12.
And where are you right now?
We're at...
Are you still, because as at March last year, you were at 14.9%.
No, March this year.
Oh, this year. Oh, March this year. Okay. I beg your pardon. So that's for March this year. Yeah. But let's also talk about your capital adequacy ratio. Yes. That you say that is robust at 17.9%. And I've also had conversations with other CFOs from other banks, and we talked about how the IFRS 9 is going to impact on their earnings, because this time it's a different kind of strategy for making provisionings for impaired loans. So what is the Union Bank story?
Okay, the last time you asked me this question, you asked me what we expected to be the impact of IFRS 9. And what we said then was that we had sufficient reserves to absorb the impact of the adoption of IFRS 9. And that's what has happened. We came into 2018 with sufficient reserves such that the adoption of IFRS 9 effective 1st of January this year has had no impact on capital adequacy ratio, which is why we closed last year at 17.8, and at the end of Q1, we're at 17.9. Okay. So it has had no adverse impact on the bank's capital adequacy ratio.
Well, I guess you're one of the lucky ones then. Talk to us about your debt recovery efforts. I understand you're still going aggressive on that one.
Oh, definitely. If you noticed, in our full year 2017, we recorded about 6 billion naira from debt recoveries, because we're going at debt recoveries in a very aggressive way. Now, if you have NPLs, it's a job of any responsible management to go after it. So we expect to realize nothing short of that again this year. Of course, it's episodic, so you cannot take any bets on the timing.
Especially since if you're going to have to take legal action in some cases.
In some cases, yes.
Okay, let's talk about opportunities that you see in this space this year. I've spoken to a number of bank CEOs this year, and they've pointed out some opportunities, some sectors that they will be focusing on this year. The likes of agriculture has come up, manufacturing, and of course, with lower yields at the market, there's talk about banks now focusing more on the real economy. Share your thoughts on that.
I mean, as a serious bank, as a bank that's committed to Nigeria's growth objectives, we are tailoring our strategy to align with the sectors of the Nigerian economy that are central to the government's growth agenda. So we are targeting segments like agro-allied, not just agriculture generally, but agro-allied. We're targeting sectors that speak to Nigeria's need to substitute importation. So we're doing that both with consumables, FMCGs, and with services, health, education. Those are the segments that we're targeting. Okay,
how optimistic are you about the economy for the rest of the year? I mean, we're approaching full half year, first half of the year. We're going into an election cycle. Speaking to a number of business leaders, I can sense a bit of nervousness. That's uncertainty of what to expect, going into the second half of the year. But what is your perspective?
I mean, there's always uncertainty, yes, but Nigeria seems to be right now to be on the roll. We're at the foreign reserves at a 4-year high. Oil price, for reasons not within our hands, oil price is going up again. So the macro seems to speak of continued improvement. Everybody's nervous around elections, and nobody knows what will happen. But from what we see of the statistics, the improvement in the economy that started last year seems to be continuing.
Okay, finally, I mean, you embarked on a strategy for for a major turnaround for the bank.
Yes.
How well is that strategy? Would you say it's working now?
Oh, it is working now. We believe that we have finished transformation 1.0. We're now in transformation 2.0. And that's a phase at which, having rebuilt the base, the base of the bank, rebuilt the architecture of the bank, people, systems, technology, we are now focused on optimizing what we've built, drawing more productivity out of what we've built. So yes, we believe that the transformation of the bank has worked, and you can see that in the numbers. Last year, we grew the deposit book by 22% at group level, in Nigeria by 26%.